Hi everyone, my name is Kaustubh Kale. Trust you're doing absolutely fabulous. So we had earlier done a video about recency bias. In this video, we will talk about loss aversion biases. Firstly, to begin, what exactly are these behavioral finance biases? So a bias is basically an opinion that you have developed, an investor has developed, which may be prejudicial or your mind is clouded to a certain thought or to a certain opinion, which may not be the best or the most optimal for your portfolio. And that is why you may not take the most right decision or the most fair decision, which will lead to a better return or a lower risk of your portfolio. So it is important that you are cognizant of these biases, and you always tell yourself that you have to take the best decision and not exhibit this bias. Hence, it is best to be aware of the bias so that whenever you are exhibiting the bias, you try and avoid doing the same. So what is loss aversion bias then? Loss aversion bias means that you prefer avoiding losses than acquiring equivalent gains. So for example, the psychological impact or the emotional impact of a loss of, say, an example, let's say 1,000 rupees, that you are losing 1,000 rupees, the psychological and emotional impact is much more than versus a gain of 1,000 rupees, then the joy that you show or the joy that you feel when you gain 1,000 rupees. So basically, the pain of a loss is much more than the joy that you feel of an equivalent gain. So let's take a very simple example to understand this. Let's say you bought a stock at 100 rupees and the stock price falls to 80 rupees. Now, most people, your friends, your family members, or even you must have shown this behavior that you would not want to book the loss at 80 rupees and you would wait for the stock price to go back to 100 rupees, and that is where you will sell it. Now, either problem kya hai that you don't want to take that loss. You want the loss to get nullified to get break even. Now, tell me one thing: if the stock is attractive at 80 rupees, you should be ideally buying more of it, isn't it? So this was loss aversion bias. Now there is another example. Say you invested 1 lakh rupees in a set of stocks or in an equity mutual fund. Now this 1 lakh has grown to 1 lakh 50,000. People exhibit a behavior that they want to book that 50,000 rupees of profit and exit. They want to let this profit be booked and take the profits away, and don't want, and they are very attached to this that they don't want to lose even a part of this. So अगर आप इधर देखोगे तो problem क्या होता है? You don't let your winners run. Okay, that is one problem, and you keep your losers as it is. We saw it in the stocks wala example. So the point ideally is you should take an optimal decision which is based on that particular investment or that particular stock or that particular instrument that you are holding, कि whether इसका जो profit है ये book करना चाहिए depending on the fundamentals of that investment, या इसका जो loss है ये book करके exit करना चाहिए. It should be purely depending on the fundamentals of that investment and not on the basis of your psychological or emotional attachment to it. So अगर आप देखोगे, in the example that we saw where the stock fell from 100 to 80 rupees and you were willing to hold, okay, वहां पे आपको loss भी हो सकता है, correct? The stock can fall down even further, but you're waiting and you're okay to wait till it reaches back to 100 rupees, correct? And in the other example where you had invested 1 lakh in a particular instrument that grew to 1 lakh 50,000, you wanted to lock its gain and move back. So what does this mean? This means that the investor shows highly risk averse behavior when facing a profit, selling and locking in the gain, and shows more risk tolerant or risk seeking behavior. Matlab, he is willing to take more risk when facing a loss, continuing to hold the investment and hoping that its price rises again. What we saw in the second example. So the point is, all your decisions have to be purely based on your financial plan, your asset allocation, on the investment that you have made, on the instrument that you are holding, on the fundamentals of that instrument, and not based on any emotion. So this was about loss aversion bias, guys. Whenever you are exhibiting this behavior, stay aware and take an investment decision which is best for your portfolio and your financial goals. Thank you so much. Do like, share, and subscribe.